Preparing a multi-step statement of comprehensive income, or the SCI. So a multi-step income statements are one of the two income statement formats businesses can use to report their profits. A multi-step income statement reports a company's revenues, expenses, and overall profit or loss for a specific reporting period. That is why income statement is also same with profit and loss statement. So it's the same thing. So you can call it income statement or you can call it a profit and loss statement. A multi-step SCI is called a multi-step because there are several steps needed in order to arrive at the company's net income. And also the difference between the single step SCI is more commonly used by the service companies, while the multi-step format, it is more commonly used by the merchandising companies. So you need to classify first what type of companies is that, so that you can decide what uh, format you need to use in preparing the SCI. So let's review what is service companies and what is merchandising companies. So when it comes to service companies, these are the companies who are selling their services, like for example the PLDT company. So they do not sell physical goods or any commodity. They are only offering their services to the customer. But when it comes to merchandising companies, they sell physical goods. This includes the hard commodity that we have. For example, the type of merchandising business is department store. So we have retail, we have wholesale. So that includes the merchandising companies. And again, it is a more detailed alternative to the single-step income statement, and it uses multiple equations to calculate a business net income. So an income statement, also called a profit and loss statement. So that is given on the first slide. The multi-step income statement details the gains or losses of a business in a specific reporting period. So it offers an in-depth analysis of a business financial performance. Its format separates a company's operating revenue and operating expenses. So from its non-operating revenue and non-operating expenses. So by differentiating between a business operating and non-operating accounting, the multi-step income statement gives insight into how a company's primary business activities generate income and affect costs as compared to the performance of its non-essential activities. So a multi-step income statement also differs from an income statement in the way that it calculates net income. So when it comes to single step, it includes only one calculation. But when it comes to multi-step, we will be using different formulas and different equation and different calculation. So multi-step income statements, on the other hand, use multiple equations to calculate net income. So here are the multi-step income statement formulas. So these are the three formulas you need to use for this method of calculating net income. So to calculate the gross profit on your income statement, you use the formula gross profit is equal to net sales less cost of goods sold. And to calculate the operating income, you use the formula operating income is equal to gross profit less operating expenses. And to calculate the net income, you use the formula net income is equal to operating income plus non-operating items. This is the example of the single-step SCI. So if you can observe, we have here the name of the company and it reflects the revenue, the company, the expenses and losses, and the net income. So we will see the difference between the single-step SCI with the multi-step SCI. So this is the sample of the multi-step SCI. So we have here the heading. In heading, it includes the name of the company, the type of the statement. So it is the statement of comprehensive income and the period coverage. So it is for the year ended December 31, 2018. So we have here the sales. So the sales is the total amount of revenue that the company was able to generate from selling the product. So the total sales here is 500,000. And we have contra revenue. So when we say contra revenue, it should be subtracted from the sales. So it includes sales return and sales discount. So sales return. So sales return is the account debited in order to record returns of the customer or allowances for such return. And when we say sales discount is the discount given to customer who pays at an early period. Or these are the customer who pays early or on time. So we have to give them the sales discount. So the sales return is amounting to 30,000 and the sales discount is amounting to 10,000. And for us to get the net sales, we have to subtract the sales from sales return and sales discount. So 500,000 subtract by 40,000, we have the net sales of 460,000. So let's move to the third part, the cost of goods sold. So the cost of goods sold is the account represents the actual cost of merchandise that the company was able to sell during the year. So the cost of goods sold is composed of beginning inventory, the net cost of purchases, and the cost of goods available for sale plus the ending inventory. But when it comes to net cost of purchases, we have purchases, purchase return, and purchase discount. So let's start first with beginning inventory. So the beginning inventory is 250,000, and for us to get the net cost of purchases, we have first to determine the purchases. So the purchases amount is 100,000, the purchases return is 20,000, and the purchase discount is 10,000. So the purchases, it is the amount of goods bought during the current accounting period. And the purchase discount, it is the account used to record early payment. So 100,000 subtracted by 20,000 less 10,000, we have the net purchases of 70,000. And let's move to the freight in. So when we say freight in, it is the transportation cost of merchandise purchased by the company. So in the single step, we called it transportation expense only. But here in the recording, the multi-step, we have to record it as freight in. So we have 15,000. And we need to add the net purchases to freight in. So 70,000 plus 15,000, we generate a total of 85,000. So for us to get the cost of goods available for sale, we have to add the beginning inventory plus the net cost of purchases. Again, the net cost of purchases is 85,000. So this one. So don't be confused with this one. So the net cost of purchases, the item under the net cost of purchases is from here, purchases to freight in. So that net cost of purchases is amounting to 85,000. And we have to add it with the beginning inventory. So 250,000 plus 85,000, it will generate 335,000. So that is the cost of goods available for sale. And we have another item here, the ending inventory. So the ending inventory, it is the amount of inventory presented in the statement of financial position. So that the total cost of inventory unsold at the end of the accounting cycle. So sales less cost of goods sold is gross profit. So we need to get the net sales. So the net sales is 460,000. Subtract by cost of goods sold, which is 285,000. So we generate a gross profit of 175,000. So we have the fourth part, which is the general and administrative expenses. And the fifth part will be the selling expenses. So under general and administrative expenses, we have salary expense, rent expense, depreciation expense, utility expense, and miscellaneous expense. So general and administrative expenses are not directly related to the merchandising function of the company, but are necessary for the business to operate effectively. And when it comes to selling expenses, these expenses are those that are directly related to the main purpose of a merchandising business. So all the expenses in the selling will be included here. So we have salary expense, rent expense, depreciation expense, and utility expense. So we have to add this. So 20,000 plus 15,000 plus 10,000 plus 5,000 plus 1,000, we have 51,000. So that is the total of the general and administrative expenses. And for the selling expenses, we have 10,000 plus 8,000 plus 7,000 plus 6,000, we have a total of 31,000. So we need to add this 51,000 plus 31,000. We have a total of expenses which is 82,000. So 82,000 will be subtracted to the gross profit so that we can get the net income. So the gross profit less the expenses will generate a net income of 93,000. Okay, we have to remember if it generates a positive result, we call it net income. But if it will going to generate a negative result, we will call it net loss. So this is a simpler multi-step SEI. So this is the example of a simpler version. So if you can observe, we have here the heading. So we have here also the net sales. And if we take a look with the cost of goods sold, it is not really itemized. So we only write here the amount of cost of goods sold. So we do not itemize the items under the cost of goods sold. So that's the simpler version. We have here the gross profit and the net income. So by that, it ends the procedure on how to create a multi-step SCI.